Welcome to the weekly video update, where I'll go over the action in the market for the week of October 30th through November 3rd, and then we'll see how things look for the week of November 6th through the 10th. We're switching back to more positive on the daily charts, and we're actually kind of extreme positive in the short term. We're showing a lot more improvement in the intermediate term, and we're switching back to positive in the long term when we compare it to the 200-day simple moving average. We're getting kind of a mixed picture when we look at the weekly charts, and I'll go through all of these and we'll try to reach some kind of a helpful conclusion. Before I get started, please know that there is a PDF that I post below each video that I upload, and you can download that and look at the charts, look at the slides. Some people find that very helpful just to kind of see things in a little different way that maybe you can't see on your screen as well. Each day I do post the pivot points, and some of these are intraday pivot points. There's another one for pivot points that last for the entire month. That's on the community tab on the YouTube channel. I can't really do that on Rumble. I do have a private Facebook group that you're welcome to join. As I've been saying, there doesn't seem to be an awful lot of interest in that. I'm pretty much the only one posting right now, but if you want to join and have some back and forth, you're more than welcome to do that. I will go through the results of the latest poll, and then I'll be posting some questions for the upcoming week. I do really guard YouTube comments. I appreciate the comments that I get, especially the ones that are legitimate. And even if you disagree with me, that's fine. It's the bot comments and the crap comments that I go through and delete immediately. Also know that I do post the videos on Rumble. Now, I've been having some problems. In fact, as I record this over the weekend, Thursday's video still hasn't finished doing its thing so people can view it finished. Then on Friday, I didn't have any problems doing that. But this kind of comes and goes. There are times when Rumble just doesn't want to accept the videos that I'm trying to upload. And sometimes I can even run into this problem on YouTube. That's why I post on two different channels. So if you go to either one of those and you can't find the video, and it's usually by a time that I have them posted, if you feel comfortable with that, go to the other platform and see if the video is posted there. That's one reason for posting in two different places and two completely different platforms. All right, let's go back and talk about the session. For the week, wow, we were up 5.85%. We hit that correction territory a week ago, and we were looking quite negative. We had broken through support. Well, we started to turn and come back up. We're dealing with some positive seasonality right now, and things really shot up. This is one of the stronger weeks that we've had in quite a while. We did have above average volume. It's tapering off just a little bit, but when you take it all together, we're still above average. Our technicals were mixed right now, and I'll go through and show you some extreme positive, negatives, some things that look positive, some things that look negative. We're in the process of turning more positive on the daily charts. It's about inflation, interest rates, growth concerns, earnings season. We just came out of the busiest week for earnings. And then, of course, the geopolitical events that I don't have on here, which can include what's going on in Israel. Our trend is still weakening. We're negative. The red line's on top, but it's coming down. The green line's going up a bit, but the ADX itself is below its moving average, and we're getting down to that 20 level, where we're switching back over to positive on the daily charts. Here we go with the different indexes. The Dow, and this is from Friday to Friday. The Dow was up 5.1%, the NASDAQ up 6.6%, the S&P up 5.9%. They rounded that up. And the small caps had a really good week. They were up 7.6%. They've just been getting hammered. Well, in this past week, there was a lot of enthusiasm for small caps, and the folks jumped in. So just to go through some bullet points, the stock market ended up having really solid gains in the heaviest week yet of earnings reports. The S&P was able to get back above its 200-day moving average and the 50-day moving average. Both of those are quite positive. Earnings news that came out was generally positive. Yeah, we had Apple that came out, and for whatever reason, the market didn't like that, but they closed well off of their lows in Friday's session. What really helped stocks this past week, not only were positive earnings reports, but interest rates really dropped. We were dealing with the 5% level. Now we're bumping back down to the 4.5% level, and that is a huge move. And we did see some weakness in the US dollar index, and that together with the interest rates really helped promote higher prices. To go through another thing that happened, the Bank of Japan, they got in there and they're messing around with their yield curve to try to control things. But the way they're doing it, it's not as hawkish or not as fearful to the market as what they thought might happen. And so this helped ease some of the fears. There are some fears that are going on in Japan that could flow through at some point and affect the US. They're trying to combat that right now to see if we can avoid that kind of a thing from happening. This is something that I've known about for over a year now, and I keep it in the back of my mind. I'm just waiting for the time to talk about this more in depth, but until it gets really bad, well, I haven't really seen the need. Another bit of positive news was the Treasury came out and said for their fourth quarter borrowing estimate is a mere $76 billion less than what they thought. Yeah, what you could do with that kind of money. Also, for the fourth quarter, refunding would involve larger issuance. They're going to issue more bonds at all the different maturities and auction sizes. They're going to open them up. Now, you would think this would be negative for bonds because this means they're flooding the market with a lot more instruments out there. So there's a huge supply, and now we have to wonder if there's a demand. This ended up being positive, at least for right now. It may come back to bite the markets in the future, but for right now, the market liked that. This past week, the FOMC did meet and they made their announcement. They did not change rates. They're still at 5.25% to 5.5%. And then after that, Fed Chair Powell gave a press conference, which was seen as market friendly, and that really helped the market hold up in Thursday and Friday's session. The Bank of England ended up leaving rates unchanged. And the economic reports that have been coming out, now this scenario is shifting a little bit. That, yeah, we have been dealing with the idea that the economy is stronger than expected. Well, the last slew of earnings or economic reports that have come out have been lower than expected. And so this is giving the market the idea that maybe the Fed may not cut rates, but maybe they're done actually raising rates for right now. This could always change. And these are scenarios that are ever evolving and sometimes just plucked out of thin air until reality makes that scenario go away. And there's a fear of FOMO that may be happening right now. This is an acronym for fear of missing out. We hit a pretty low level. Things were looking really bad. And now we've just reversed and started to come back up over 5% in 1 week. And now you have people that are like, oh my gosh, I missed this move. I better get in. It's going to go higher, higher, higher. Well, when we get to that point, that usually means either a short to intermediate term top in the market. Since the majority of folks that don't really pay attention to what's going on, they tend to arrive late and arrive at the wrong time when most of the party is already ended. Here's a look at the VIX, and I'm also showing this in the daily videos where we topped out in October. October is usually the worst month of the year. And now we're starting to come back down with the VIX. We bounced back up a little bit. Now we're wondering in the circled area, are we going to continue to fall with the VIX? As this falls, that's more positive for stocks. Also keeping an eye on inflation. We're trying to see if the match between the 1966 to 1982 is going to be what ends up playing out here. That's the gold line. Now, this chart hasn't been updated for a while, so we're a little bit over here, but this is a very long-term chart where we do see a decrease in inflation, and then we see a pickup after that, and then we see hyperinflation after that. We don't know if that's how things are going to play out, but if you're going to compare these periods of time with each other, you've got to take the more positive with inflation going down with the negative with seeing this hyperinflation type environment. We settled at 4.51% for the 10-year yield. Like I said, we were dealing with 5% just last week. Interest rates really coming down gave a lot of support to stocks, but we're still above that 4.02% level that, according to RenMax research, suggests that when we're above that level, that's when it starts biting into corporate earnings. Going through our poll results, and this poll is about a week old, so we'll have to see how things come out here. The first question I ask is, what do you think will happen first? Is the S&P going to break below 4,100 and head towards 4,000? 55% said that is what will happen. 45% said that we will bounce and possibly recapture 4,200. Yeah, we're above 4,300 now. The next question, oil and interest rates pulled back in the week that just ended, and they continued pulling back in the week that we just finished now. Do you feel that this will continue, or will oil and interest rates go back up in the upcoming week? 63% thought that oil and interest rates will go back up. 13% thought they will go down, which is really what ended up happening. And then there was also this third question, oil and interest rates will likely move in opposite directions. And they're kind of hand in hand with each other still. Then the next question, stocks are coming into a historical positive time of seasonality. Do you feel that this will happen again this year, or are we going to deviate from that pattern? 56% thought that we will stick with what historically has already happened, where 44% thought that we are going to deviate. Now, this is kind of an ongoing thing, and I may ask this question in the upcoming week as well, because we're in a period of positive seasonality that goes longer than just 1 week. Then, as of a week ago, on October 27th, all the major indexes have fallen below significant support, except for the NASDAQ 100. It was still above its 200-day simple moving average. Do you feel that this will end up being support? We never did get down to that level, which may produce a bounce, or will the markets continue to fall? 80% thought that the markets will fall. Well, we had a rip-roaring market going in the opposite direction. And as I said, we never got down to the 200-day simple moving average before things started to reverse. Looking at some Isabel Net blog charts, these are just charts that I show. These are estimates going forward, whether it's Morgan Stanley or the consensus, that we're going to see positive earnings growth going forward, and that justifies higher stock prices. This is a little bit of a concern. We did have the employment situation report come out, and it's the red line that we're following here. It's all employees and even including temporary help, where we're falling below this red line. And typically when this happens, that means that the market is light, or the economy is likely to go into a recession. You can see where it happened back in the early 2000s, then during the great financial crisis. Of course, it happened during COVID, but we're starting to see that now. But we have a slew of other charts that suggest that we might not be going into a recession. So we're seeing a little bit of contradiction with this information. Some earnings or FactSet earnings blog posts that we went through, I have 2 of them. I'm not going to read through this whole thing. This is updated as of Friday, where 81% of the companies have reported. 82% have been above estimates. And then when you take it all together, I have to search for this because I don't want to read through this whole crazy thing. In aggregate, companies are reporting earnings that are 7.1% above estimates. And the average is the results from the 500 companies, not the actual results from the percentage of companies that have reported through this point in time. It's just the way that they like to benchmark this kind of measurement. Earlier in the week, they had another blog post where they say those S&P 500 companies with more international exposure are reporting an earnings decline of about 5%. That's the green area over here, where you take all of the companies together, they're up 2.7%. And when they get most of their revenue from the US, they're doing even better. Then looking at our different charts, here's the intraday chart going back to the beginning of the week, where we were pretty much flat in Monday's session. And then we started to show a little bit of an improvement on Tuesday. Then the market got pretty quiet on Wednesday. This is when the Fed was going to come out and make their announcement. It gyrated right after things were announced, and then we ended up taking things higher. We were still below the 200-day simple moving average. Well, in Thursday's session, we opened above that and pretty much went higher from there. Then in Friday's session, we were able to get back above the August 2022 high. And so there's a lot of levels that have been recaptured now, and that is positive for the market. So for the week, you had the small caps, which ended up doing the best. They've been in last place quite a bit, followed by the mid caps, the NASDAQ and NASDAQ 100. But when you just take the 5 trading days, all of the different indexes were up. Going back to the beginning of the year, we still have the small caps, which are negative. All of the other indexes are now back to being positive, with the NASDAQ 100 followed by the NASDAQ. And then going back to the all-time high, all of the different sector indexes end up being negative, and we're going to be that way until we finally get to a point where a new all-time high is set. Looking at the different sectors, we had an up week, and you had real estate, which has just been getting slaughtered in 2023. It ended up doing the best, followed by financial, which has also been under a lot of pressure. And you had discretionary, which has been stronger in 2023, but then has started to see some weakness over the past few months. Well, it came roaring back this past week. Communication, another strong area, and then tech. The area that was down the least ended up being the energy sector, and it was up. So all the different sectors were up. Looking at the relative rotation graph, where we're seeing that energy is still strong. That's the green area here in the plus area, but it is starting to decline. Communication was showing some weakness. Now it's coming back up into the strong area. And then we have tech, which is showing some improvement. And then we have discretionary, which has been a little bit weaker, but could possibly see some improvement. And then the areas that had been weak are real estate and industrials, but even they are showing a bit of an improvement in this chart. Then looking at the different sectors just for the week, real estate was up the most, where you had staples, energy, and healthcare being down the most. Going back to the beginning of the year, these are the same three areas that have been strong: communication, tech, and discretionary, where all of the other sectors are down going back to the beginning of the year. They have a lot of repairing to do. Going back to the all-time high, we have energy, which is still in the lead, followed by tech and industrials and healthcare. All of the other sectors are still negative. Looking at sentiment, we ended up closing at 42. Once we get above 45, we'll go more into a neutral stance. Where this helps is when we look at the historical chart. We started to get pretty negative here, pretty extreme, and then we showed a little bit of a bounce. Then we started to come back down again, and now we're showing some improvement. When this gets to an extreme reading, either above 80 or below 25 to 20 or so, that's when we start looking at this as a contrarian indicator. The active asset managers. Now, this is a week old, but they were starting to get extreme negative and showed a little improvement, but they're still extreme negative. And when we get a reading like this, we tend to use this as a contrary indicator as well. Here's another chart showing how we're down below 30 at 29.17. Looking at the VIX, where it was a lot higher, it was above 20. Well, it just shot down over this past week. We declined well below 20 with the line chart as well as the bar chart. The Ulcer Index is above its moving average and starting to come down, where it's just barely starting to roll over on the daily chart. But this is another fear gauge that we look at. Folks were starting to get pretty fearful with the RIDEX bear bull ratio. When this goes up, that means they're more fearful and they jump into the bear market mutual funds. When this gets to a really low reading, that means they're in the bull market mutual funds. And the latest reading of the American Association of Individual Investors, now this is a week old, and they tend to react to what's already happened, and they were starting to get pretty extreme negative. When we look at cash and compare it to the tech sector, this is still holding up quite well. With this black line going down, that is more positive. That means tech is outperforming 1 to 3 month T-bills, which you could pretty much call cash. Keeping an eye on GDP, the latest reading from the Atlanta Fed GDP Now estimate, we're up here in this area just a little bit over 1%. Well, we're about 1 3/4% to the upside to actually being somewhat negative. Now, this is going to change quite a bit, and there's not a lot of data here to really look at because we ended up starting a new quarter at the beginning of October. Here's the bar chart where now we're starting to focus more on the fourth quarter. We already had the latest reading from the third quarter, so it's still looking positive. And this is one of the areas that if this drops negative for 2 quarters, that's one of the parts that goes into the definition of a recession. Then here are the estimates going forward, where we're right about in here with the black diamond here. The Goldman Sachs is a little more optimistic about things. That's the gray area, but it still has us going with positive GDP, both according to Goldman Sachs and according to the consensus. And looking at the spread between risky and not as risky bonds, this is actually continuing to go down. If we were running into trouble, this would really be going up. Then we have the latest reading of the Financial Conditions Index. We ticked up just a little bit, but we're still below the black line. As long as we stay below the black line, that is more positive. And we do have some of our longer charts that have been updated. but not this one. This is just showing how bank tightening standards have been getting more strict. Here's one of the updated charts, the real-time SOM rule recession indicator. It is ticking up, but we're still below the red line. That's when we get concerned, is if we go above the red line. And we're just pretty much flat here when we look at the smooth U.S. recession probabilities. Again, we get excited or get nervous when we go up to the red line, and we're just barely above the black line. The Brave Butters Kelly leading index, it actually started to tick down where it was getting up and being a little bit concerning right now. But the fact that this is going down means that it's less likely that we're going to head into a recession. Looking at inflation, this is the inflation nowcasting. Just it takes the CPI as well as PCE and just every day comes up with an estimate of where inflation is at. It's actually picking up just a little bit with the PCE and the CPI, but the core areas still remain at the same levels. Keeping an eye on the Fed. This is as of the close on Friday, November 3rd. There's a 95.2% chance that the Fed is going to leave rates unchanged. This will change since we won't be meeting with the Fed again until the 13th of December. And here how this has changed, where the blue areas where we're at now, then we go a day before, a week before, and a month before. And this has been rising with the consensus that we probably won't see the Fed raise interest rates. Now that could change. We get a bunch of stronger than expected economic reports, and it could freak out what seems to be happening right now. Then looking at the balance sheet where it is declining, and that's one of the statements that the Fed made, is that this decline that you see, that's going to continue. And Chairperson Powell just came out and reiterated that. They started it in June of 2022, and then it got bumped back up during the banking crisis. Well, now it's continuing to go back down. And then this is the year-over-year change where it's just showing how this is decreasing. Now getting into our charts where we're showing some improvement with the advanced decline line based on price, we're coming right back up to the moving average. We did see a little nice bounce here with volume, but we're still below the moving average. The new highs, new lows, we're seeing more of an expansion of new highs and less of an expansion of new lows. We're not quite turning up yet with our 4-week moving average, and we're still flat after we had been declining with our 10-week moving average. The advanced decline ratio, we're above the midpoint with the red line, which is a slower line. And the blue line is showing some improvement, but it's still below zero. So this is giving us more of a mixed picture. Accumulation distribution, we're looking better on the daily chart, and we're showing some improvement here, but we're still below the moving average. And this tries to measure what is the smart money doing. Our trend is the ADX is the dark blue line, and that's the main indicator that we focus on. It's getting ready to cross down below 20, which means in a weekly time frame, we will not be in a trending environment. But we still default to negative because the red line's on top, even though it's declining. The green line is coming back up, but it's still on bottom here. We are in the process of switching back to more positive on the daily charts. We look at both the short-term and intermediate term chart in those videos. The Arun indicator is still looking more positive. We're above the oscillator right now. The green line are sellers, are buyers, and it shows that they've been really declining. The red line are sellers, and they've been flatlining, so we haven't seen a real change here. I'm still including the daily chart in the daily videos, but it's just been acting really strange lately. The mass index, we ended up getting a false signal on the daily chart, and we're still far away from a signal on the weekly chart. Some of our other charts, here's the daily chart, where first at the bottom, you can see where we've been above average, but we're just coming back up. We were able to get back above the 200-day moving average, and then on Friday, we got above the 50-day moving average. We still have some resistance. We closed right at this pivot level. And some other charts that I'll show you may suggest that we might be hitting the underside of some resistance. We're coming back a little bit on the upside of this trend channel going back to 2009. That's switching things more positive. And looking at the daily pivots where we hit that resistance in July, and that's where we topped out and have been having trouble since then. If we continue to go up, we'll be watching this level because it may still provide overhead resistance. Looking at the 50-period simple moving average, we dropped down below it. That was turning more negative, but now we've been able to bounce up out of that, and the red line is still going up. So this is switching back to more positive. The long-term trend is also showing a lot of improvement. It's coming back up to its 13-week moving average, and it seems like it might be trying to save this longer-term uptrend. The McClellan oscillator, this is one of the extreme positive readings. We're above this 60 level. Now, we could still go up more than this before we really get more extreme, but this is something to be a little concerned about, even though it's positive. You could switch that over to a positive view, just saying, look at this great momentum that we're seeing. Then looking at the summation index based on price, we're still below zero, but bouncing up. On volume, we're also showing some improvement, but still below zero. Looking at the Swenlin trading oscillator, and this ended up being kind of a leading indicator for us this time. Doesn't mean that happens that way all the time. But the Swenlin trading oscillator started turning positive on the daily charts before we started to see that with price. And now we're also seeing this really going up based on price and volume. We're just about to an extreme positive reading based on price. The bullish percent index, this is also quite positive. We came down and we dropped below the 30 level. Well, this past week, we shot back up above that. Now we're still below 50, but this is technically a buy signal, and this is being confirmed by what we're seeing on the daily charts. Then we look at the PMO study. It takes a longer period of time for our momentum oscillators to turn back. So we're still negative with the PMO, showing some improvement with the PMO based on price and volume, but still below zero. We're already getting extreme positive with the PMOs that are rising, showing a lot of improvement with the buy signals. And after getting extreme negative, we're bouncing back up with the PMOs that are above zero. The percent B, which measures, did we go outside of the upper or lower Bollinger Band? Well, we did, but now we're starting to show some improvement. You can see up on top where price is starting to come back up to the midpoint. Here are our oscillators, and we're starting to get extreme negative with the slope. The TSI is still negative, the MACD, the PMO, all of these are negative, where we're in the process of switching back over to positive on the daily charts. The Chaikin money flow did tick up just a little bit. This is a little bit of a concern. It was actually giving us some positive signals, but then we had that solid up day on Friday, and the CMF actually went down. And this tries to be another smart money indicator. The Chaikin oscillator, after getting extreme negative, is now starting to bounce back up. The force index crossed back above zero and is green. That's positive. We're turning up. It's still below 50 with the money flow index. And we're getting extreme when we look at the 1 week rate of change. We compare this Friday with last Friday, and the market just goes, whoa, maybe we've gone up a little too far too fast. Then we go back 50 periods right now, and we look at 50 periods ago or 50 weeks ago, and this is starting to show a little bit of an improvement. The RSI based on 14 weeks is crossing back above 50. That's turning more positive. However, the daily special K weekly chart and now the daily chart are negative. We're dropping below the red moving average. The Stochk RSI has crossed above the 0.5 level. That's the midpoint and is turning more positive. The Williams percent R is just barely above the midpoint. This is looking more positive too. The ultimate oscillator, after giving us almost an extreme negative reading, is showing an improvement, but we're still below 50. The vortex still has the red line on top, even though it's declining. So this is negative, but we are seeing some improvement as the green line's trying to go back up too. The Kopik curve is still in a downtrend, even though it's turning back up slightly. We recaptured a lot of these longer term support, which had been resistance levels once we fell through them. But this is the 40-week moving average, which would equate to a 200-day moving average, and we got that back. And then we have the 10-week moving average, which equates to a 50-day moving average. And to get back above both of those is quite positive. Our different charts, we're looking a little bit better with the Heikin Ashi. This is more like a doji in candlestick talk, where we pretty much opened and closed right here. We're still looking negative, but showing some improvement. Where the Kegi chart is still negative, it has a red line, but now it's pointing up. And we're still negative with the Renko chart, and we're looking a little bit better now with the 3-line break. The ease of movement, you can see this real big spike up here when we go from 1 week to the previous week. We are turning up with our 14-week indicator, but this is still below zero, so it's negative. We did have some new X's drawn in here now, and so that's turning things more positive, and they're green. And we have on October 30th, on the weekly chart, we had a low pole reversal that was generated. A day or two before that, we also had the same pattern signal come for the daily chart. All right, looking at our different trading systems, we're turning back to positive with the Elder's Impulse system. We're still negative here with the parabolic SAR. On Thursday and Friday, we switch back to positive with the daily chart. And then our longer term PPO studies, we're flattening out in the long term, showing some improvement, but still negative in the intermediate term. And we're actually turning more positive in the short term. And then some daily charts. This is one area of concern, and I pointed this out in the daily video. We're really starting to go up. You can see this is a daily chart. Look how we skyrocketed back up to these previous levels. We're wondering, is this going to provide overhead resistance here? But look at how growth has really been underperforming value. In a good, strong environment, we want to see growth really going up, and it's not doing that right now. We did get back above this 100% retracement level with our short-term fib chart for the S&P. We're above the 61.8% retracement level on the longer-term fib chart, and we're coming back up above this double fib line that we fell below, and now we're getting comfortably above this. We're above this quadrant level here. And then we also were able to close above this resistance level. And here's the daily chart where we have two dots underneath with the parabolic SAR. We're coming up to the underside of this long-term trend. Now, this is a daily chart, and this measures from the October 2022 low and then connects the March 2023 low and then extends this line forward. We broke through some trend lines here, but we've been able to recapture that. Is this next longer term trend line going to offer overhead resistance? And this is another concern where the transports are not outperforming the S&P. When this is really going up, see what the market was doing at that time? Well, we've ticked up just a little bit, but we've been going down. So we want to see some improvements here. The NASDAQ 100 has some overhead resistance. It was able to get back above its 50-day moving average. I was wondering if we might come all the way down to the 200-day moving average. We didn't do that. This support area ended up holding right on this pivot level, but we have an R1 pivot level here, and we have the previous all-time high right here. And you see, this is where we stalled out earlier on. Are we going to be able to break through this time? The FANG index is looking more positive. We were able to close back above the 50-day moving average, and we're still in a longer-term uptrend. And the different support levels for the FANG index also held up. Now, these were intraday, where we were bouncing down around here and fell even lower. Well, we were able to get back above that. Now, I probably could draw a trend line here, wondering if this is going to offer overhead resistance. In fact, I'll do that in the next daily video. But this is showing some improvement. And we're coming back above this weekly chart for the S&P 500 going back to 2009. We were underneath the trend line. Now we were able to close back above it. And the financial sector, which has been under a lot of pressure, it shows here that this support level is continuing to hold, and we're bouncing up off of that. Some broad market measurements. We're now in the month of November, which 80% of the time tends to be up 4.5%. Then looking at just a blank chart of the S&P where we're showing some improvement, the mid caps are also turning back up, but they were getting hit pretty hard. We are also seeing some improvement with the small caps, but we're going to need to see follow through with this to turn things even more positive. When we look at the weekly chart of the Dow, we are coming back up to its 13-week moving average here, and so we're still in a longer-term uptrend. The NASDAQ weekly chart coming back up to its 13. Sometimes I use 10, sometimes I use 13 on these charts. We're coming right back up to this level, and we're still in an uptrend. The NASDAQ 100 is continuing to come back up and look more positive. The mid caps, they're still coming off of a recent death cross, but did have a good week. They were up over 6.5% on the week. And then you had the small caps, which were up 7.45% just in 1 week, but they're still looking pretty negative on the weekly chart. The NYSE showing some improvement, and we're getting really close to a death cross here, though. And the all stocks did really bounce back. We're rolling over with the blue line, but we are showing some improvement here. The biggest software companies, after giving us a death cross, have now come back up to both of these moving averages. The FANG index is looking more positive on the weekly chart. And ARC, which is just giving us a recent death cross on the daily chart, it's looking more negative on the weekly chart, but it was up 18.5% just in this past week. The bank index, we're showing some improvement with the RSI on top. We're trying to bounce back up here on the price chart, but we're still looking more negative with the MACD, showing momentum is still negative. Looking at all of the different deposits in banks, we actually declined this past week. It's hard to see that over here, so you can look at this negative number over here in the top right. Looking at Dow theory with no additional studies on here, we're still going back up with the Dow and showing some improvement. The transports were back up, but we want to see this really start to follow through. Utilities, which have been just getting hammered as interest rates were going up, well, with interest rates going down, utilities ended up having a good week. Some other broad market measurements. The CRB index, we're still in an uptrend on the weekly chart. Oil is continuing to fall. We hit that 95 area, and now we're starting to come back down on this chart. Copper is still looking more negative, where it's kind of chopping sideways for right now. And the dollar, which did come down this past week, is still in a longer-term uptrend. Gold, which is just getting ready to give us a death cross here. We already have a death cross on the daily chart, but the geopolitical uncertainty that's going on, that is pushing the price of gold up, although it's far from really breaking out, at least here with this ETF. Silver also showing some improvement after giving us a recent death cross. Looking at bonds, where we are still negative with the bond ETF on the weekly chart, even though we did show some improvement. When we look at stocks to bonds on a monthly chart, it's showing how stocks continue to outperform bonds. The 1 to 3 month yield, this is kind of interesting. We're back to a zero result. When we take the 1 month and subtract the 3 month, we should always get a negative answer here, because the shorter month, you'll get less interest than if you tie up your money for a longer period of time. The fact that they're back to even with each other, not quite sure what to make of that right now. We did see a real fall off in interest rates over the past few days, and that really helped stocks. Here's a weekly chart showing how the U.S. is still in the lead with the highest interest rates, followed by the U.K. in black. German rates are coming down, but they're in third place, and Japanese rates are starting to go back up. Some relative studies. Here's an intermarket analysis chart where now we have stocks back in the lead, where a week ago oil was in the lead. It's still hanging in there, but now gold is in second place, and then oil, and then right about at the same point is the dollar. Bonds are negative, but they are showing some improvement. Here's going back to the beginning of 2022, where we still have oil in the lead, followed by the dollar and gold, where stocks and bonds are showing some improvement, but still negative. The ratio from the NASDAQ 100 to the S&P just has the NASDAQ 100 outperforming, even though both indexes have been doing well in 2023. The S&P 100 continues to outperform the rest of the S&P 500. Growth of value coming down, and this is an area of concern. On the weekly chart, it's still in an uptrend, and it's still hanging in there on the daily charts. But we want to see this really go up and give us some strength. It's not doing that yet. Gold to the S&P, with stocks going up and gold being under a little bit of pressure, this ratio really came down. And gold is also not able to break out when compared to the US dollar. Bonds are continuing to underperform stocks on this shorter term ratio. And low volatility stocks are starting to come back down. We thought maybe we had set some kind of a double, in fact, triple bottom here. If they continue to fall, is it going to come down and test this area again? Discretionary to staples, this is a little bit disappointing. We're falling back a little bit, and it's not that discretionary is doing good, it's that staples are doing really bad when we look at this ratio overall. Energy to tech sector, where energy was really making a roaring comeback, well, it's now fallen off as the tech sector saw a bit of love this past week. Looking at our long-term trend studies, this is the NYSE breadth thrust, which now over a year ago, we had a buy signal that was generated, and that still remains on the books. This is much longer term, but it's positive. Then the ZWAG NYSE breadth thrust, which was generated last March, that's when we had an extreme negative reading, and then very quickly after that, we saw a positive reading. This is still on the books. Now, we could be getting another signal here, but we didn't go quite negative, but this might be generating an additional signal. The Zohorchak method, which is still coming down a little bit after giving us a full-on buy signal, we'll wonder if this is going to show some improvement if stocks continue to go up. Here's a longer term weekly chart of the S&P where we're still below this longer term trend line when we go back to 1987. And then here's the shorter look at that same chart, just going back to the beginning of 2018. We're still below this longer term resistance level. We're also below this longer term resistance level with the NASDAQ 100. And when we look at a ratio between the NASDAQ 100 and the Dow, we're still at a pretty lofty area, but we've been chopping around lately. And then we look at the QQQs, which is the NASDAQ 100, and compare it with the IWM, which are small caps, where we might have been coming back to this previous high, and now we're starting to tick down. This could end up providing overhead resistance. Now, I have to qualify this. If you take the NASDAQ 100 and the small cap index, you'll get a result that shows these levels are about the same. I'm using ETFs in this because that's the information that I have available. And then we look at the cumulative new highs and new lows for the NASDAQ. They continue to drop off, but they've been dropping off now since the latter part of 2021. We're looking a little bit better with our raw score here, but we're still below zero. And we're still wondering if this is even going to become an issue. This is the 3-month yield, which continues to go up, even though it was down this past week. We're wondering if this rolls over and comes back down, is that going to generate a warning sign like we saw back in 2007? Here is the latest research from Tom Bowley, where November ends up being a very bullish month. Utilities are weak, and you have industrials, which are hot. And now, in the beginning of November, we're up 66.8% of the time from the 1st through the 5th. We've already passed that now because Monday's session will be the 6th. Now we enter a time where we are kind of negative, 6.5% of the time. Then we get into another positive period, and then a negative period, and then we finish out the month looking quite positive. We have the airlines as an industry group, and we have the transportation services, also another industry group, which tends to be positive in the month of November. This is maybe it's because of Thanksgiving, because everybody's flying or riding somewhere. So this is just for a Monday session. This is the outlook. We're still dealing with earnings season. We're still dealing with the situation in Israel. On the daily charts, our technicals are positive, but in the short term, we're becoming overbought. We won't get any economic reports in Monday's session, and then the whole list of geopolitical events. Yes, please be reminded that there's still a war going on between Russia and Ukraine. That hasn't been getting much headlines these days. It's mostly about Israel, but that has still been happening. Here is the economic calendar for the upcoming week. Not really any huge thing in and of itself. It's kind of a lighter week as far as the economic reports are concerned. And then here's the Stock Traders Almanac statistics. Now, I'm going to go through this a little bit more, and I still haven't changed this to November. Just pretend that this is November at the top, where it ends up being the best month of the year. We are up 68% of the time and down 32% of the time. And then I'll talk about options expiration as we get closer to that. But just for Monday's session, we are positive across the board with the Dow, S&P, and NASDAQ. We will be on the 4th trading day of the month when we start Monday's session, where we look at the green dashed line. That's a pre-election year, and that tends to be positive. And then we're looking at the whole month during a pre-election year where this tends to be positive. It doesn't mean we go straight up, but this ends up being more positive seasonality. We're also seeing positive seasonality from 1928 up to 2022. And then looking at the NASDAQ during a pre-election year where we do tend to see better performance throughout the month of November, but it doesn't mean we're going to go straight up. We spend some time seeing some weakness as well. And this is just historically what has happened. It doesn't mean it's going to play out that way this time. And then looking at the S&P, where we do see a strong beginning to November before we see a little bit of weakness and then some strength going into the end of the month. So our scenarios, and again, this is just for Monday's session. We're no longer going with the down scenario. We're going more with the up scenario because we're turning more positive, and we're not going with the sideways scenario right now because even though the ADX is weakening, it's still above 20, suggesting that we are in a trending environment. So our warning signs based on Friday's action. Growth is underperforming during the recent rallies, and I've been pointing that out in the daily videos. And that is a bit of a concern. It can always change, but it seems to be happening day after day now. The daily and weekly special K charts are negative. The longer-term equity put call ratio is still going up, and that's negative for the market. The risk on posture, it bounced up in Friday's session, but it's still showing a stronger decline. The vortex is negative, but showing some improvement. There's a new high, new low study that I go through in the daily video. That is still negative. And the Russell small caps and mid caps, based on their daily charts, they're still working off of death crosses. The financial sector generated a death cross a week ago, but it was able to close back above its 200-day simple moving average after Friday. Then longer term, the trend signals, the S&P 500 and NASDAQ 100 weekly chart, where we're still below those longer term trend lines. That's what I'm talking about here. The cumulative new highs and new lows for the NASDAQ continue to show weakness, but they've been doing that for a few years now. The 3-month yield is above where it was back in 2007. We're wondering if that's going to roll over. We're wondering if that's even going to be relevant, but we still keep an eye on that. And then earnings season can be either positive or negative. Even though earnings were taken as positive this past week, Apple, the real big one, they ended up really not pleasing the market. The positive signs, our 5-period equity put call ratio has now turned and is starting to go down. That is positive. We're switching over to positive with our S&P 500 and NASDAQ 100 oscillators. The parabolic SAR chart is now positive, as is the bullish percent index crossing back above 30. Small and mid cap growth, they've been chopping sideways, but they're still in a longer term uptrend. The positive signs longer term, we have seasonality and historical things that we look at, and November ends up being the best month of the year. The longer term seasonality and setups, the other charts that I showed earlier in the video, those are still there. There's the Horchak, the NYSE breadth thrust, the swag breadth thrust, those. And then we're still above that downtrend channel upper line. I actually had to dust that one off a little bit because as we were going down, I thought we might hit that level if things really got out of hand, but we've turned and have started to go back up. So our conclusion, and this is just for Monday's session, we are more positive, we're becoming overbought in the short term, and we're right underneath that trend line, which could be acting as resistance. In the short term, we're turning more positive, but also dealing with a little bit less of an overbought condition, and we might be dealing with resistance. Intermediate term, we're turning more positive and we're slightly overbought. Long term, we switch back to positive because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. Please feel free to check out the daily videos. I will be preparing the intermarket analysis video and the deep dive video as I conclude all of my week of videos. So I hope you have a very nice weekend, and I will talk to you in the next video.